Welcome everyone. Thank you for listening to this webcast. So as we just said, so my name is Jules Bloch. I'm a portfolio manager here at JPMorgan. We are a team of three. So the other two are Jack Featherby and John Ingram. I think it's fair to say we're seeing more and more interest for small caps at the moment, especially in Europe. So very good time to just update you on the trust. So what I'll do is I'll start by explaining why we're so positive on European small caps right now, both for the long term, but also why we believe it's a good time to buy them now. Then I'll try to explain what we do in the trust. So what's our investment process, what type of stocks we're looking for, and how we are managing risks. And finally, I'll touch on more kind of recent performance, top holdings, so you can understand what you're investing in. So if I start on the first slide, so let's start with next slide again. Brilliant. So let's start with the long-term picture. And I really want everyone to remember this picture because it's very important. European small caps is an amazing asset class. In the past 30 years, our benchmark has delivered an annualized return of 9.3%. This is truly outstanding. So if you invested in the index 30 years ago, you would have made 10 times your money. So that makes it one of the best performing asset class out there. And we really believe this will continue. When we think about the reason for this outstanding performance of European small caps, it's basically down to earnings growth. Small caps can grow their earnings faster than large caps by about 2 to 3 points per year on average. And that makes a huge difference in terms of long-term compounding. And this will just not change. The reason they're growing faster is just because they're small. It's just easier to grow when you're a small company. And many of the companies we are currently invested in, they're not mature yet. And they can still grow for a very long time. Now, I want to make it very clear because there's often this misperception that if they're not mature yet, then they can't be high quality. And this is completely wrong. When I say they're not mature yet, I don't mean they're unprofitable, long-short startups. In our portfolio today, not a single company is loss-making, not a single one. When I say they're not mature yet, I mean they're operating on growing markets or they're still at the start of their growth journey. So we, for example, own a retail chain in Finland, which is called Thriller. Thriller currently has 40 stores, and they want to have 80 stores in 5 years, so doubling the number of stores in 5 years. That means they'll grow double-digit every year by opening one store every 2 months. And that's the power of small size, because let's say Walmart wants to do the same, double their network in 5 years, they would have to open 8 stores every single day. And so that's why being small is such an advantage. Another advantage of being small is M&A. We have a lot of companies in small caps that can generate very high profitable growth by doing small bolt-on acquisitions. Again, this is only possible because they're small. Because once they get bigger, they need to acquire bigger businesses, there's more integration risk, the targets become more expensive, you start to compete against PE, with private equity, and so on and so on. So we own a stock, for example, it's called AQ Group, it's an industrial stock. They have revenues of 700 million today. They can easily add 5 to 10% top line growth by making 5 deals a year. And these targets are easy to integrate. They pay them 4 to 6 times EBITDA. They get a good return on this investment. And then that means they can grow 10 to 15% per year on average. So the reason small caps outperform over the long term is because they have a size advantage, and that allows them to grow faster and for a longer period than large caps. And that will never change. Now, on the next slide, what we think is also amazing about the small cap asset class is there's an amazing opportunity for alpha creation, for outperforming the benchmark. This is a segment of the market where there's still a lot of inefficiencies. In European small caps, you can really find this, what we call them hidden gems, that people are overlooking. And so if you look at this slide, it's pretty amazing. Over the past 20 years, we've identified more than 60 European small cap stocks that have gone up more than 10 times, more than 10-fold. Some of them, you can see on the slide, have gone up more than 50-fold. Reply, scour, Auto Software, Forknox. And Forknox is the most extreme example, but this is a software company that delivered 38% annualized return since the IPO in 2007. It's pretty amazing. And we know from experience that a large part of our long-term performance is actually driven by these outliers, these outstanding exceptional stocks. That's what we call hidden gems. And as a team, we spend a lot of time, a lot of energy to find these stocks. And that's how we created Alpha. So you have an amazing long-term asset class, but also there is a possibility for outperformance on top of that. Now, where it gets really exciting is that now we believe it's a really good time to buy European small caps. So on the next slide, you can see, so these stocks are trading at very, very attractive valuations now. It doesn't get enough attention because saying something's cheap is not very exciting. It's not exciting to talk about AI changing, but remember that the best indicator of your long-term performance is current valuation. You pay a high price, you get a low return. You pay a cheap price, you get a high return. That's just how it works. So we're all aware that the outperformance of the US has been the norm since 2008, basically. But as you can see on this slide, it has led to a very stretched valuation differential between the US and Europe, which means today you get a double discount on European small caps because Europe is trading at a large discount to the US because the S&P at 22, 23 times, Europe is more at 15 times. But then you get a double discount because European small caps are trading at a much lower valuation than large caps. They're trading at around 12 to 13 times. So this is a huge valuation anomaly. Small caps usually trade at a small premium to large caps because they offer more growth, as I just explained. But today they're at a 30% discount to large caps. This is very, very unusual. The last time it happened was in 2000. And if you look at the performance in the following 5 years, so from 2000 to 2005, small caps outperform large cap by 75%. And we're kind of in the same situation just right now. So we know from history that outperformance of different markets can cycle, and we believe time has come for European small caps to catch up. And the reason for this catch-up is a recent change in the German fiscal policy. So if you look at the next slide, small caps are more domestic focused than large caps. So on this slide, you can see the share of revenues that companies generate from different regions. So 58% of revenues from European small caps are coming from Europe. Compared to large caps, it's only 31%. So when Europe was struggling with high energy costs, the uncertainty of the Ukraine war, and very restrictive monetary policies, as you would expect, small caps underperform large cap by a wide amount. The thing is, now it's really changing. We think we can already see it in the performance. The NAV of the trust, the net asset value of the trust, is at 19% year to date. And the reason is inflation is falling, which means lower interest rates, which is better for growth, and that's good for small caps. But more importantly, we think growth is coming back to Europe. And we believe people don't fully grasp the tectonic, the shifts that's currently happening in Germany. But this is the largest economy in continental Europe, and they will spend an additional 1 trillion euros in the next decade, including 500 billion on infrastructure and defense. And just to give you an idea, 500 billion is 11% of German GDP. It's twice what they spent during COVID to support the economy. To give you an idea, it's equivalent of the GDP of Austria. So it's really a huge change. And the companies that will benefit the most from increased spending, they're the companies that are the most exposed to Europe, because this money will be spent in Europe. And it's really good news for small caps. So we have companies in the portfolio today that really directly benefit from increased fiscal spending in Germany. Bilfinger, for example, which is an industrial service company, very exposed to Germany. SPIE, again, they're doing electricity installation. Again, a huge play on German infrastructure. So in conclusion, if you think about the asset class, you've got an asset class with an exceptional long-term growth track record. You've got amazing alpha creation opportunity that's currently trading at a very attractive valuation compared to any other market. And on top of that, it should really benefit from the German stimulus. So that's why we're so excited at the moment. So that's for the asset class. Now, if you go to what we're doing in the trust, so on the next slide, there's probably one more. Yeah, excellent. So On this slide, you can see a more generic description of the trust. So the trust invests in European small caps, excluding the UK. So we're focusing on continental Europe. What we define as small caps is usually stocks below 10 billion of market capitalization. The smallest stocks we currently own is about 500 million. So 500 to 10 billion is a good estimate of where most of our stocks will be. We hold about 70 to 80 stocks on average. We are 75 now, so just in this range. We don't have any constraints in terms of sectors or countries. We're very flexible. We just invest in the stocks that we believe has the highest return potential, basically. So it's a pure bottom-up stock picking investment process, and I'll explain on the next slide how we do it. You can see gearing. Say on the previous slide. Yeah, gearing is important. We can be up to 20% cash or 20% to 20% geared. And the idea of the gearing for us is really to just magnify these long-term returns. And our approach to gearing is actually pretty simple. We want to be in this 5 to 10% gearing range most of the time, except if we see market extremes. So if the market is really, really overpriced or very, very cheap, we can move. But at the moment, for example, we are about 7% geared, which is right in the middle of that range. And then on the right-hand side, you can see performance. You can see we've been successfully outperforming the index over most period. We are both benchmark net of fees over 1, 3, 5, and 10 years. So that is a confirmation of what I said earlier. It is possible to generate alpha consistently in this asset class. So it's very encouraging. Now, the question is, how do we actually do it? So on the next slide, it's important to spend a bit of time on what we call investment philosophy or investment process, because this is a way we want to deliver performance. So we have a very well-defined objective investment process. So we are a team of 3, and we are all looking in the same direction. We're looking for quality, momentum, and value. So the first question we always ask ourselves when we're looking at the stock is this a good business? That's what we call quality. We want to invest in companies that are operating in growing markets, have some sort of competitive advantage that is basically protecting them from competition, where the management is taking the right decisions, that's very important, and where balance sheet is not a constraint. So if I take an example, a company like Scour24, for example, is a very good example of what we call quality. So Scour24 is the leading real estate platform in Germany. So you can think about it like a right move of Germany. So is the market growing? Yes. I mean, real estate agents are increasingly using this platform to sell real estate. Do they have a competitive advantage? Yes, again. I mean, this is a platform business with huge network effects. So the leader takes it all, basically, and they're by far the number one. Does the management take the right decision? Yes, again. A few years ago, they decided to sell their subscale automotive platform in order to reinvest everything in the real estate platform where they're much stronger. That was an extremely good decision. And the balance sheet is very clean. So that's the type of stocks we are calling quality. Now, a business can be very high quality, but if it's already reflected in the valuation, the stock is actually unlikely to materially outperform. So the second question is it attractively valued? So the way we think about value, a stock is not valued to us if it just has a low multiple. That's not what we're looking for. A stock is valued to us if the stock trades below the intrinsic value of the company, which means there's some sort of misperception in the market. So 2 years ago, for example, we started to invest in banks again, so Italian banks, and they were offering good value. We thought they were attractively valued because there was a misperception that banks are structurally bad businesses. But the reality was, for many years, these banks had been suffering from zero interest rates. So once interest rates normalized, suddenly these banks were good business again. They started to generate very good returns on equity, paying back money to shareholders, and they were trading at 10, 15% dividend yield, which is pretty amazing. And that was due to this misperception that they are bad businesses. And we made a lot of money on Italian banks in the past 2 years. And the last is what we call momentum. And the basic question here is the outlook improving? we use momentum as a timing tool. So we believe there are good and bad times to invest in any stock. Because basically, a company that is cheap but continuously miss expectations will probably continue to underperform. And so we want to invest in companies that are beating market expectations. That's very important. So we're very focused on what companies deliver, not in absolute terms, but against market expectations. That's what we're looking at. So what we're looking for is good companies trading at reasonable valuations that are beating expectations. And that's the recipe we've had for more than 20 years. It's proven to work over the long term, but more importantly for us, it's consistent and it's very repeatable. So I talked a lot about stock picking the right stocks, but risk management is equally important. So if you go to the next slide. So we take risk management very seriously, and that's where being at JPMorgan is so important, because JPMorgan spends billions and billions in technology every year, and that gives us a massive advantage. So on this slide, you can see our internal software. We call it Spectrum. It's entirely customized to all needs, and in there, we have real-time quantitative and qualitative data, but all stocks listed anywhere, but also about all portfolios. And we have decades of data. So inside the software, for example, we'll have an application, which we call the risk dashboard. And we use a risk dashboard to manage portfolio level risks. So it shows us in real time what risk we're taking at the portfolio level, what style, sector, countries, currency, stock specific, and so on. There are also macro factors. So for example, it helps us understand how the portfolio can be expected to behave in different macro environments. For example, today, we have an idea of what the portfolio will do if there's more or less tariffs imposed by Trump. So we use this tool in order to manage exposure. If we are unhappy with the absolute amount of the risk, we can reduce it or increase it based on that risk dashboard. So just in conclusion of this part of the presentation, what we do with stock pickers, we follow a very strict investment process, focus on quality, value, momentum. And then we add a very strong layer of risk management to make sure that the stock we have selected, they assemble in a very coherent portfolio. So that's what we do. Now, if we go on the next slide, probably one more. Yeah. So that's the result. That's performance. That's a long-term performance. What I can say here, we are outperforming over most periods, so 6 months, 1 year, 3 years, 5 years, 10 years. And that's despite a very poor 2022 and 23. We can come back to that. You're probably aware there has been a management change in early 2024 with Francesco Conte, who had been, he's retired. He retired after managing the trust for more than 20 years. And I'm very happy to say, given the numbers you see here, performance since then has been really good. And the reason is he built a team before leaving, so the team was ready. So in 2024, very good performance, 8.7% alpha in 2024, and so far in 25, we're also well ahead of benchmark. So very encouraging numbers. And then the next slide, you can see more detail about what drove the performance over the past year. So we have performed about 2.5% over the past year. What's very interesting in the top contributors is it's a mix of value and growth stock, which shows that we are actually style agnostic and happy to make money anywhere. The first one is Bilfinger, which we think is an excellent company. Bilfinger is a German company. They're doing industrial services, mostly for heavy industries, so chemicals, petrochemicals, and so on. We bought the stock, again, because there was a misperception. The market was wrong. Historically, Bilfinger was a poorly managed business with a lot of construction exposure. But then the management changed. They sold the construction business. They focused on improving the margins. And that was a much better business. But something happened next, which is there was an energy crisis in Europe. And many businesses in Germany, especially in chemicals, were really struggling with very high energy costs. And they needed help to reinvent their processes, to make their process better, to save energy and so on. And that's exactly what Bilfinger could help them with. So today. So really good performance so far. And on top of that, Bilfinger is now considered to be one of the main beneficiaries of increased German spending, because they're very exposed to Germany, very exposed to industrial German industrials. And so we're still very positive on this name. Second is Lottomatica. They're the leading gambling franchise in Italy. We bought the stock because we felt the valuation failed to reflect the growth opportunities of the company. And what's happening in Italy and in many countries actually is the share of online gambling is increasing. So the penetration of online gambling is still very low, but it's increasing, which means they're growing really fast. But what's happening is online gambling is a much more profitable business for them, which means the margins are going up really, really rapidly. This is also a company that's benefiting from favorable regulation, because at the moment, the Italian market is very fragmented, and the government doesn't want it to be fragmented. So they're raising the barriers to entry for smaller players, which means Lottomatica is either gaining market shares organically or just acquiring struggling small businesses. Then the two next ones are Unipol and BAWAG. I would group them together because they're both financials. So I've talked about our investment in financials. This is a sector that's been decimated by zero interest rates. It's been uninvestable for a decade, but now they're really, really interesting businesses with high dividend yields, good earnings growth, no problem with balance sheets. So we're still very positive on financials. And the last one is Alzchem. This is a German specialty chemical company. They have leading position in pretty niche markets. Historically, it was feed additives, dietary supplements, agricultural chemicals. But now we are seeing two main pillars to their growth, which are growing double digit. One is creatine for human consumption, which is used to repair and build muscle. And it's been proven to have proper health benefits, so it's really growing a lot. And then another part of the business is a propellant, which is called nitroguanidine, which is basically an explosive that go into NATO munitions. So a clear beneficiary of increased spending in defense. I won't talk about top detractors unless there are questions, so we can go on the next slide to see how the portfolio looked like at the end of March. So that's the top 10 holdings. I'll just rank them by theme again. So the two first one are actually plays on fiscal stimulus, on German stimulus. So I talked about Bilfinger, which is more on the industrial part. SPIE is more on the electrification part. So anytime you need to install a cable, install an electrical substation, a heat pump, HVAC system, or whatever, that's what SPIE does. So they're a clear play on increasing spending infrastructure. They're very exposed to Germany. Lottomatica I've talked about, but again, we can have a group of platform businesses, digital businesses that we really like. So Lottomatica I've talked about, scour24 I've talked about, CTS17, which is the sixth one, falls into that category again. So CTS17 is a leading online ticketing platform for live events in Europe. And I'm sure you've all seen the numbers and the anecdotes, but spending on live events is booming. Like, people are spending a lot of money on this experience. I've checked, but there's a Oasis tour coming. It's expected to generate £1 billion in spending, and it's only 17 concerts, so it's pretty amazing. The sector is booming, and just like Lottomatica, there's an increasing online penetration, and that's more profitable business for them. So not only it's growing, but the margins are going up as well. And then you can see financials. So again, a play on interest rates, basically on the normalization of interest rate, I should say. So Unipol, Store Brand, and Banco Commercial Portuguese are in this financial sector. So you see a very well diversified portfolio, I think. You've got growth, you've got value, you've got cyclical, defensive. The most important for us in the end is really company-specific drivers. And that's really what we're focusing on, is finding hidden gems that will really generate exceptional performance. And with that, I think I'm very happy to answer any questions.
Thank you. So On page 22, there is a sector attribution slide. And the question is, can you explain the sector attribution percentage, please? I don't understand why allocation is sometimes negative, which I assume is that the allocation is relative to benchmark, but...
Paulina, can you show the slide?
So the slide is 22, I think. Then you do performance attribution. And I presume the question is about the relative weight percentage and the fact that that can go negative, but that's presumably the negative is an underweight relative to benchmark.
Yeah, I think it's more positioning. So that would be the positioning of the trust versus the benchmark, I would guess. I don't think we'd give any performance. Thank you. Oh, okay. So that's slide 22. So basically, there are two ways you can generate performance in terms of versus a benchmark. One is what we call stock selection, which is basically you take a sector. So let's take travel and leisure. Okay. In travel and leisure, we have a company called Do & Co, for example, which is airline catering, is doing really well. But let's say you've got another company which is an airline and it's not doing well. Well, that will be stock selection. Is investing in the best stock, not investing in the other ones. That's stock selection. Another way to generate performance is what we call asset allocation, which is more related to overweight or underweight to a sector. So at the moment, for example, we're overweight to banks. So if banks are doing well, we'll generate some outperformance from the bank sector. Historically, and that's what happened in 2022, for example, when we had bad performance, we've lost a lot of money on allocation, meaning we were not in the right sectors. So, for example, we didn't have any defense, we didn't have oil stocks, we didn't have banks, which meant in 2022, we lost a lot of money on asset allocation. So what we've done, and there's been a change in the management team, we've started to reduce sector risk, which is asset allocation. And the reason is we're very good at picking stocks, at understanding what companies are doing. But if you take big sector risk, it's actually a macro call. So you're on the macro, and we know that it's very hard to be right on the macro. So we've reduced asset allocation risk, and you can see the bars, the blue bars, are much smaller than the stock selection. And that's because we don't run a lot of sector risk at the moment. We focus on what companies are delivering, finding hidden gems, and that's what we do. I hope it answers the question.
Thank you. I think that addresses that question. There's a comment that one attendee can't hear anything, but I think that's a lone voice because I'm not getting the equivalent from anybody else. Question, is there any form of hedging in the portfolio?
Quick answer, no. No, I mean, I assume it's hedging about currencies. We don't use currency hedging. If we look at, again, coming back to this idea of a risk dashboard and understanding where our risk is coming from, currencies only account for 2% of the risk. So it's really marginal. So we don't feel the need to, I mean, most of it is in euro anyway.
Thank you. Which areas of the portfolio are most likely to benefit from an increase in German fiscal spending?
Yeah, I mean, to us, it's really infrastructure plays. We're invested in construction company. I mean, Bittinger is the most obvious one because that's probably the second largest stock in the portfolio at the moment. But this is a company that basically needs a bit more confidence from German industrials, and what they're seeing already, because we're talking to the management quite regularly, they're clearly seeing people start to invest in Germany again. Obviously, the money hasn't been spent, from this 1 trillion or 500 billion. However, the impact it has on confidence is very important. And today, in terms of countries, one of our largest overweight is Germany, and that's for this reason, basically. But yeah, defense, I talked about Alzchem as well. I mean, defense is really booming as well.
Super, thank you. A comment that it's not a very high conviction portfolio with just 22.5% allocated to the top 10 holdings. And I before you answer that, I would just counter that there's a fairly consistent alpha generation here, which may well be part of your answer.
No, I think it's always a debate. We know some of our peers have much more concentrated portfolios. We also run at JPMorgan more kind of diversified strategy with more like 150 names. I mean, that's a good question. The thing is, the more concentrated your portfolio is, the less you can change it. But yeah, I mean, we feel we're very comfortable with 70. That's the way we've run the portfolio for 20 odd years. It's fair to say at the moment, because there's a lot of policy uncertainty with Trump changing its mind every morning, we are running a slightly less concentrated portfolio because the situation can change really quickly, and we don't want to take too much risk. If he announces something tariffs tomorrow, that's very big. We don't want to be too concentrated in one sector. But I think if things calm down, maybe we'll run a more concentrated one, but we'll never be a 25 stock portfolio. That's just not what we do.
Thank you. New question has come in. Did you say you could invest in companies up to 10 billion? That doesn't seem like a smaller company size. It seems you lean more towards mid caps. Has this changed over time? Might it change in the future? And what are the merits of mid over small?
Yeah, that's a good one. So we have a few stocks that are above 10 billion. Now, quite an exception, and the reason we still own them is because we bought them below 5 billion. So these are stocks we bought when they were below 5 billion, but they've done really, really well. And so we are happy to let them run, although we are pretty close to selling them. I should mention, the work we've done recently is to go into smaller market caps because the trust has the advantage of being a closed-end vehicle. And so there's an area of the market where we probably under-researched sub 1 billion companies in the past, and there's a lot of effort at the moment to find these stocks. The challenge we had historically is that there's no research on them, sell-side research, so it's actually quite hard to identify them. But we've set up a screen that basically allows us to screen for these really hidden sub 1 billion stocks. And we're very, very happy with the results so far. So we invested in a few of these. They have, I mentioned AQ Group during the presentation. That's one we identified. Now it's almost 1.5 or 2 billion. And so we are finding good ideas there. So above 10 billion is kind of an exception rather than the norm.
Yeah, I think because you talked about inefficiency and the capacity to produce alpha that results from that inefficiency, that's a two-edged sword. So part of the reason of that efficiency is that you are operating down in an area where there is less research and where there is less. So it is your sort of specialization, I guess. Thank you very much. On the sector positioning, the slide 47, you appear to be overweight banks, but underweight financial services. Can you just talk a little bit about that?
Yeah, I mean, the problem is financial services is there are a lot of things in there. They're not necessarily interest rate related. So you would have trading platforms, for example. You had payment companies, and it's a weird mix of businesses. We don't own, I mean, I'll give you an example. Like Worldline, which is a very structurally challenged business in France, in the payment business that built an enormous empire. That would fall into diversified financial. So where we see interest in financial is really banks and insurance, where they offer really good dividend yields. We have one trading platform, which is a Swiss company called Swissquote, which is a really high quality business. But we're not invest. I mean, financial services happen to be a mix of different things that we are underway to.
Okay, thank you. And on the regional allocation, you're not, I think, perhaps quite as long as of Germany as one might have expected, given the presentation. And the other one that strikes me is an underweight in Spain, which feels a little contrarian.
Again, so just Spain, we're just struggling to find. It's down to stock picking rather than market. Remember, when you see this sector and country allocation, that tend to be the result of stock picking. So we don't really make decisions based on what country trades in or whatever. In Spain, it's fair to say we're just struggling to find ideas. And if you think about the allocation, you can see, I think, Italy and Germany being overweight. Then on the other side, we've got Switzerland. And Switzerland, it's down to stock picking. We found the market very expensive. We don't find any good value in these stocks. It's hard to invest in Switzerland because just the stocks are really expensive. And there's a lot of medical equipment, for example, stocks in Switzerland which are not doing well, which did extremely well during COVID, and now they're kind of struggling with the normalization of their business. But yeah, it's down to stock picking in the end. We just it's stock picking, but then we monitor how much risk we're taking from countries. And it's pretty similar to currencies. It's like 3-4% coming from country allocation. If you think about Europe, it is a block. Like, I know there are differences and so on, but in the end, it's one economy. That's the way we see it.
Thank you. You're a management team of 3. To what extent are you constrained or otherwise by JP Asset Management processes and philosophies? How much freedom do you have around those?
Good question. I mean, the investment process as I described, so on value, quality, momentum, is common to many teams here at JPMorgan. That's been the long-term kind of investment philosophy of the team, of the global team. So that's the way many of our large cap funds are managed. We are constrained by a risk team. So we basically get audited very frequently to understand what type of risk we're taking, if risk is appropriate compared to what our mandate is, if it's in accordance with what clients want. Now, we're also benefiting from all the tech investments from JPMorgan because, if you're only a small cap shop, you can't spend 35 billion on technology. So we're benefiting from this ripple effect from having large cap funds, basically. Now, in terms of freedom, apart from risk management and process, the stock selection is entirely done to these 3 people, John, Jack, and I. We have complete freedom.
And as between 3 of you, is there a sort of primus inter pares, and how do you make decisions about stocks you want to buy and sell when there's disagreement between you?
Yeah, I mean, it's an excellent question, and it's a question we get very often because we are a bit different in that it's a very team-based culture. So obviously, John, for example, is much more senior than I am. He's been in the industry for maybe 20, 25 years. But the way it works is really we take decisions together. So we debate every investment idea. If there's agreement, like all of us really like the stock, then it will be a big position. If there's disagreement, then we can size it down. So the level of conviction inside the team is basically based on, the sizing of the position is based on the level of conviction inside the team. The reason it works is because we have this investment process, so we can at least all agree they check the box on value, quality, momentum. So we have a common framework at least to make sure we're looking in the same direction. It's very team-based.
And what's the spread of the three of you? Are you exclusive to the European Discovery Trust, or are you managing multiple portfolios?
So Jack and I Jack and I really sit in the European small cap team. So it's all we do. We are managing small cap mandate. John is the boss of a bigger team, which is called Dynamic. So there he will manage different strategies. So they also have all cap strategy. They have a technology long short strategy, and different hedge funds.
Super.
But Jack and I are really on small caps.
Thank you. Can you talk a little bit about costs, management charges, and also about historical discounts, and whether or not young Bowers Weinstein has been knocking at your door at all?
Lot of questions. The management fees. I'm not entirely sure of the numbers, to be honest, because it's more board level discussion. But I know they've reduced the fees this year, and I think it will be announced in the annual report. Second question was discounts. The discount at the moment is 6%, I think, last time I checked.
Yes, 7, I'm saying yes.
The board is very, very keen to manage the discount effectively. So there's been a tender of 15% in 2024. And they're doing share buybacks pretty regularly. So they're very focused on the discount. They don't want it to widen too much. And then on the last question was Saber. Yes, he was a big holder of the trust. It is our understanding that he's significantly reduced his position. I don't know exactly where he is, but close to zero.
Okay, and there's no thought of adjusting because you're effectively a liquid portfolio, aren't you? There's no thought of moving into an OIC or similar as a restructure.
Manually.
Okay. Thank you very much. There is a question that's come in. You have some gearing. What's the likely range, and what might make you change the level of gearing in the future?
Well, so gearing, as I said, kind of neutral. You should think 5 to 10%. The reason for that is gearing is good for the long term because it increases your return as long as the market goes up. But now it also adds volatility in performance, and we run different simulations, and we're just comfortable with 5 to 10%. Then above 10%, it starts to get really volatile in an already volatile asset class. So 5 to 10 kind of normal range, and then we're just looking at different metrics. So we have a dashboard that we look at every week, every Monday, to know if we should reduce or increase gearing. But it's really based on market extremes. So indicators such as the volume of IPOs, for example. So if a huge surge in IPOs is usually toward the top of the market, that's how it works. So for example, we had a massive IPO market in 2021, so we're checking IPOs. We're looking at technical indicators. So I don't know if you're familiar with bull bear indicators, but we're looking at that effectively. And then valuations is the most important component. So as long as the valuation of your European small caps look attractive as it is now, we'll stay in this 5 to 10% range. And if the market falls as it did earlier this year, we'll probably increase gearing a bit as we did when the market fell.
Fantastic. Thank you very much. There was one further question about Trump tariffs. We've sort of covered that, but I guess the question is, favorable or unfavorable for your target companies? And
Trump tariff is a very in flux. A very, very good memo from Howard Marks at Oaktree, where he explained it. The title is "Nobody Knows Yet Again," and I think it's a fair reflection. The problem is, one, we don't know what will happen, like will the tariffs be imposed or not, and second, we don't even know what the impact will be. So it's very tough to make decisions based on that. the margin is actually not bad for small caps because they're very exposed to Europe, as I showed on the revenue exposure. And our portfolio, if you think about the portfolio, is very domestically geared at the moment. So SPE doesn't have any business in the US. Bitcoin has some, but it's people that are based there, so they're not sensitive to tariffs. Automatica is completely Italian. Then Italian banks are Italian, so we don't have a direct exposure. We know from the dashboard and from performance that when Trump's announced more tariffs, our performance is good. So we tend to outperform the market when there's more tariff negative news. But at the moment, as I said, it just creates a lot of uncertainty for businesses, and it's not good for anyone. So what we are doing, I mentioned the number of stocks, it's a bit on the high side. It's also to protect from all this uncertainty at the moment.
Fantastic. And yes, I think you had a slide 15 on regional revenue contribution by asset class, which makes the point, which underlines the point you just made. We have run out of questions. We're 10 minutes shy of the after meeting where people will mull over what you said. But I think we're that's done the trust proud in terms of a presentation. I'm very impressed with the outperformance relative to benchmark. You did change a benchmark in 2020. Is there a particular reason for that, or is
Really know the reason there?
No. Okay.
I think just people prefer the MSCI to.
Okay.
That's what other fund managers are using.
Nevertheless, yeah, impressive performance. Jules, thank you very much indeed.
Thank you. Thank you.